We asked Pension Insurance Corporation and Jay Shah, who led on this transaction from their point of view, what made it so attractive? What made them give the best price, and it was the best price we saw last year, to Pilkington?
When the opportunity to do a bulk annuity buy-in with the Pilkington scheme came about, we assessed the attractiveness of the opportunity to us. One of the key things we considered was whether the trustees had a realistic expectation around bulk annuity pricing. It's important that they have a handle on likely pricing and they have an understanding of how pricing moves over time with changing market conditions, and this they certainly had. And so it was good to go into a process where it was clear what a successful outcome would look like from a trustee perspective. When the trustees approached the insurance market, they had thought through what information they wanted to provide. So, for example, the data was of high quality. It was quite clear which liabilities they wanted to insure, and the benefit spec had been carefully drafted, had been reviewed by their legal advisors, and had been signed off. This gave us confidence that we knew which liabilities they wanted to insure, and therefore which liabilities we were pricing. These are complex transactions. You need a good advisor on board. Aon is one of those advisors. It's one of the few firms that has a very strong track record in advising on bulk annuities and bringing them to a successful conclusion. The process was well articulated to us. So, for example, we knew how many pricing rounds there were going to be. We knew what pricing feedback we would get, and we knew exactly what the trustees' requirements were going to be. And all of this helps us to ensure that the transaction comes to a successful outcome. A really important factor for insurers in determining whether an opportunity is attractive is whether the right decision-making framework has been put in place at trustee board level and also at the company level. And here we had an excellent example because a subcommittee had been formed which had the opportunity to take decisions in a timely manner in the context of moving market conditions. And actually this was tested to the limit in this example because the transaction straddled the Brexit referendum. The trustees had to make decisions either side of the referendum, and actually it's very much to their credit that the transaction was completed soon after the referendum, despite the volatile market conditions.
So to finish off the session today, I thought it'd be helpful we talked about longevity swaps and bulk annuities. For those of you who are focusing on longevity, and I think it will become a risk that, if not recognised today, will be more and more prevalent in your portfolio, which is the right solution for your scheme? And from my point of view, I think there are 6 key factors to consider. Firstly, risk transfer. Which achieves the most optimal risk transfer? Bulk annuity removes not only the longevity and demographic risk that you get from a longevity swap, but also investment, inflation, hedging the caps and collars on pension increases. So a more fuller risk transfer from a bulk annuity. Investment point of view, longevity swap doesn't require an upfront transfer of assets, but bulk annuity involves handing over a substantial upfront premium. If you're considering re-risking your assets, you might need your assets for growth, you might be using them for hedging. Bulk annuities are more restrictive than a longevity swap. Which is most complex? I think it's fair to say neither are overly complex nowadays. Bulk annuities, as you heard, very well-trodden path, hundreds of transactions every single year, fairly standardised terms. It's not to say you will accept them straight away, but a very well-trodden path. Longevity swaps, still rarer, still complex at the larger end of the market, but simplified structures are very much available for smaller pension schemes. Where's pricing now? So as we speak, longevity pricing is reasonable value. We've seen a few years of very heavy mortality rates. Not all of that has filtered through to longevity pricing yet. From a bulk annuity point of view, the pricing is still dominated by the insurance regime, by the assets they can find. And that pricing, from a funding point of view, for most schemes, is still very beneficial. And capacity, no issue with capacity in either market. Plenty of insurers, and importantly, plenty of reinsurers in the background. And finally, perhaps most importantly for sponsors in the room, is accounting impact. So day one accounting impact of a longevity swap is either nil or very, very minimal. From a bulk annuity, if it's structured as a buy-in, there'll be a balance sheet hit on day one, a smaller hit on P&L. But under international accounting standards, that can be a barrier for some companies. If you've got a US parent, it's a slightly different scenario. For a buy-in, there needn't be any impact on either balance sheet or P&L. So perhaps simpler if you've got a US parent to explain a buy-in. And finally, if you're thinking about approaching the market, what's the best way to go about this? Well, number one, preparation. And preparation is often thought of as get your data in order. Yeah, that's important, but actually you don't need your data to be perfect before a transaction. Preparation is, how might this fit within my portfolio? What's my end game? Am I going to start buying annuities when I'm fully funded on a buyout basis? Or do I want to do it beforehand? If it's before, when do I need to do that? Are my benefits complex? Do I need to simplify my benefits in some way? Who do I need to socialise the idea with? Is it just the trustee board? Is it the sponsor, etc.? So preparation is hugely important and not something that can be begun a month or two before a transaction begins. Monitoring the market's important. So for those of you who use Risk Analyzer, we have live pricing feeds from insurers. We reflect actual pricing that we've seen in the marketplace from a bulk annuity point of view. At the bottom of the chart is a press release we released last year when we saw that the longevity market simply wasn't keeping pace with the level of mortality that we were seeing in the marketplace. That's rectified itself to some extent, but you just need to be aware of, is now a good time to buy a bulk annuity? Is now a good time to invest in a longevity swap market for your scheme? Engaging in the market is all about presenting yourself in the best possible way, negotiating the best deal, including legal terms and conditions and price. Importantly, what happens if the price isn't quite right? Bear in mind you might have started this process 6 months ago, and in a 6-month period we've seen 10% swings relative to annuity pricing. That doesn't mean the process stops altogether. Setting a trigger-based mechanism, and this is our compass framework that we use at Aon Hewitt, setting a trigger mechanism means you don't need to leave the market altogether. You tell insurers, one insurer, a number of insurers, when you might transact. And because you've done the work beforehand, when the market does rectify itself, when insurers raise capital, when there's asset opportunities, when government bonds change, you'll be ready and in the market and willing to transact. So you'll be top of the queue in the same way that Pilkington were in the right place at the right time. And the final point is making the transaction as smooth as possible. So making a transaction smooth from price certainty, getting price locks, from a legal point of view, perhaps using pre-agreed contracts, and from due diligence, understanding the counterparty you're transacting with. So bulk annuities, I think, will form part of a lot of pension schemes' portfolios. What I urge you to do is to consider when, if, and how it might fit within your own portfolios. Thank you.